If you've been following Indian markets for the last couple of years, you've probably heard names like Dixon Technologies, Keynes, Amber, and PG Electroplast. And maybe even thought, should I buy these? These stocks were everywhere. They became the face of India's big manufacturing push. And for a while, it felt like they could do no wrong. Government incentives were flowing in, global brands were shifting production to India, and the whole China plus one narrative had a lot of momentum. Contract manufacturers looked like they were going to be the biggest beneficiaries. But something has changed. Stock prices are sliding, valuations are under pressure, and quietly, the government has started pivoting away from the very policies that made these companies boom in the first place. So today, let's look at what is actually going on with these contract manufacturing stocks. Is this the end of the dream? What happens after PLI? And what is this new R&D scheme that everyone is talking about? If you like videos that get into this kind of detail, share this one with a friend who follows the markets. Let's break it down. To understand where we are, we need to go back to how this story started. When the government launched the Production Linked Incentive Scheme or PLI, it was meant to kickstart local manufacturing. The idea was simple. If you increase your production year on year, the government would give you a cash payout. It was basically an incentive to scale up. Now, for companies like Dixon, Keynes, and Amber, this was a huge boost. These businesses run on volume. Their margins are thin, but they make it up by doing more. More units, more orders, more assembly contracts. So if they were getting paid not just by clients like Samsung or Xiaomi, but also by governments for scaling, it made the economics look really good. And that is when investors started piling in. And the stocks took off. Keynes was up over 900% in 2 years. PG Electroplast was up over 700%. Dixon was getting PE multiples of 50 to 60 times of forward earnings, way above its Taiwanese peers like Honhai or Wistron, who were trading at about 11 or 12 times. At that point, it looked like India was about to become the new global manufacturing hub, but that is not exactly how it played out. One big reason for the slowdown in these stocks is that the PLI story is now getting old. We are already seeing signals that the government does not plan to extend the original production incentives much further. In fact, the mobile phone PLI, which Dixon has a large exposure to, is set to expire by March 2026, and there's been no serious talk about extending it. Instead, the government is now shifting focus. Just this week, they announced a brand new R&D linked incentive scheme, and that is a big change in direction. PLI was about rewarding you for making stuff. This new scheme, it wants you to innovate, not just assemble. So what does this R&D push actually mean? In simple terms, the government is saying that we've helped you build capacity, now it's time to build capability. We want Indian companies to not just assemble parts but actually design products, build IP, and develop core technology. This is especially relevant in areas like semiconductors, battery tech, precision manufacturing, and advanced electronics. And it will open up the door for a new set of winners, companies and startups that are just getting started but that have strong technical teams and original ideas. So, if you're someone who's tracking Indian manufacturing as an investor or operator, this is worth keeping an eye on. You might be about to see a second wave of manufacturing investments, but this time led by design and engineering, not just assembly. And let's be honest, most of our contract manufacturing giants are not R&D first companies. They are excellent at executing someone else's design, but that's a very different game from creating your own. Now, none of this is happening in isolation. The market is already responding. In 2025, Dixon is down more than 15%, Keynes is down over 20%, and the entire electronics manufacturing pack is lagging behind the broader Nifty rally. Analysts have started dialing back expectations. Jefferies kept its underperform call on Dixon, Morgan Stanley downloaded the stock to a sell, and Keynes has more sell ratings now than ever before. These stocks are still valued richly, in some cases too richly for what their next few years might look like, especially if PLI support goes away. And add to this the China angle and things get even murkier. Over the past few months, we have seen signs that China is tightening its grip. There are new restrictions on component exports and rare earth minerals, things that are critical for electronic manufacturing. And more quietly, companies like Foxconn have reportedly started pulling Chinese personnel out of their India plants. Hundreds of staff who were helping run iPhone lines have been called back. That matters. These are not just workers, they are the process experts, the people who know how to run high yield, high efficiency manufacturing flows. Without that talent transfer, it is going to be very hard for Indian factories to deliver the same output and quality at scale. And that creates risks, not just for companies, but for India's entire China plus one positioning. Now, to stay competitive, some of these companies are trying to go upstream. Keynes is investing about 3,400 crores to set up a semiconductor packaging facility. Amber is putting in over 2,400 crores to expand its electronics play. On paper, this looks like progress. Companies are moving into higher value segments, but these are capital intensive bets. and they carry long timelines. There is no guarantee that demand will keep up, and when you're doing this at a time when margins are already under pressure and government support is shrinking, it is a tough balancing act. So while top line might still grow because India is a growing market, the question is whether profits will follow. And right now, the market does not seem too sure. So, is this the end of contract manufacturing in India? Not quite. There is still a strong long term case for building a local manufacturing base, especially in sectors like electronics, appliances, EV components, and telecom gear. These businesses are not going to disappear overnight, but the easy money phase might be over. From here on, it will matter more who controls the IP, who builds resilient supply chains, and who adapts to the policy shift. The ones that can move up the value chain, maybe by investing in design, software, or vertical integration, will have a shot at staying relevant. The rest, they might find it harder to justify their sky high valuations. Let me leave you some final thoughts. This shift from subsidized scale to rewarded innovation is an important one. India is telling the world that it does not just want to assemble things anymore, it wants to create, design, and lead. And for investors, this means re evaluating who the real winners of the next decade will be. If you're tracking this space, watch what happens in semiconductors, battery tech, and components. Look at who's hiring engineers, not just factory workers. Follow the capital and see if it is going into IP and not just machines. We'll continue covering this on this channel. If you found this video useful, drop a like, share it with a friend who follows markets or manufacturing, and subscribe so that you don't miss the next update. See you in the next one.